taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
Welcome to the Total Money Management Podcast. We're going to be going through the week that was April 15 to 19. How are we doing, gentlemen?
Good.
We're alive. We're here.
We're alive. We're happening.
Are we ready?
We're ready.
We are ready.
We're ready to talk about war and oil and globalization, margin debt, and more globalization.
Maybe some emerging markets in there?
Yeah.
Yeah.
Well, the S&P's taken a dump the last couple of weeks, hasn't it?
It has.
Since the 1st of April, it's down almost 6%.
Yeah.
Is that it? 6, is it? Okay.
Plenty more to go.
5.7 or something.
Yeah. One of the reasons why, just quickly, or one of the theories why, is because April is the tax collection season in the US. So in other words, everyone's got to pay their taxes. So the argument is, well, some people sell stocks and, or some people don't put as much money and stuff. So in other words, the market goes down because the liquidity falls.
Isn't it sell and may go away?
Yeah, that's one of the rules. There's some people say it's true, others say it's not, but generally, if you look at seasonality is better, which is May to, don't hold me to, I think the end of October.
Are the bad times?
Yeah, that 6 months of the market, if you stayed out of the market for that 6 months, you generally would be a lot better off if you just invested between November and April.
Buy before Santa's little rally.
Yes, well, the Santa rally was...
It gets earlier and earlier.
It's now like June.
I feel like we just make up a garbage reason as to why the market's done something.
Well,
this is because of Santa.
Yeah.
I don't mean us on the podcast, people in general.
Yeah.
Right?
Well, if you're reporting something every day and you come to me and say, Steve, market's gone down, why did it go down? I go, they're concerned about oil prices. Right, okay, write that up. It doesn't, I don't go, well, is that actually accurate, Tom? You just want to get some copy out there so people will click on your article, right? So that's why I sort of, bag the mainstream media a lot, because they don't ring around a million investors and say, mate, market's down. What's your idea?
Yeah, what do you think?
Yeah, what do you think it's down for? You get a million opinions, put them together and go, okay, 99% of them think it's the oil price, I'll run with that. No. All they do is just, Bill said it's the oil price, righto. Okay, well, Bill seems to know what he's doing. Let's just write it's the oil price. Yeah. And that's what they do.
It makes more sense being linked to tax reasons, to be honest.
Well, it's at least legitimate money flow argument.
Yeah.
But it also could just be that market's really expensive. When that happens,
it's had a great
volatility increases.
Yeah, and it's had a great run from November.
Yeah, well, it's gone up a lot, and now it's pulled back a bit.
A bit, yeah.
At some point,
hopefully it pulls back a lot more.
Well, at some point, people say, geez, I've done really well. I'm going to take some money off the table.
Yep.
And that causes more people to go, oh, Tom's selling. Okay, well, yeah, that's a good idea. I might sell a bit myself. Then the market starts falling and Jacob goes, oh, okay, I think I'll do some rebalancing here and take some profits. And that causes that's why you get the mean reversion, right? You get the momentum on the upside. Jacob's buying, so Tom buys, and Tom and Jacob are buying, well, I'll buy. And so the prices keep going up and then it turns.
Yeah, and then people start buying again.
Absolutely. That's the way it works, brother.
Well, we'll kick off with the big issue. I know we kind of touched on this last week. The one we flagged in this newsletter was watching the Middle East and whether Israel respond to the attack by Iran. Obviously, there's a number of conflicts now that appear to be entrenched and may well run a long time. Again, this just kind of confirms the new normal thesis. How do you think this is going to play out with the energy prices? I know we touched on this. It looks like, when I look at it, I would expect oil to be skyrocketing. And I know you touched on it last week, Jacob, where you said it seems to be kind of artificially suppressed.
Well, yeah. There's some supply and demand stuff. And again, it's what Jacob was saying before about, last week about the Strategic Petroleum Reserve. The US used to keep, I think it was a supply that was about 3 months supply. And now they're reducing it. And I think the reason why they've taken a different approach is because the US created the SPR, right, the reserve, because they were a net importer of oil, right? So in other words, we're relying on the world to give us what we want. Now the Americans are a net exporter of oil. So they're saying, well, we don't need to have too much in reserves because we can produce it all ourselves. So that changes the dynamic, right? And a lot of the geopolitical dynamics is changing because America is no longer reliant on the Middle East. So the Americans say, well, really, do we have to go out there and, do we have to go over there and sort them out again? Right? Saudis are fighting and, oh, God, the Iranians are at it again. And, oh, God, the Israel's at it again. At some point, the Americans historically have generally been fairly insular, right? They're a big market. There's 340 million of them. They got all the agriculture they need. They
care about themselves.
Yeah, but they don't need the external world, right? They can produce energy themselves and they can feed themselves. Okay, and the rest is a bonus. So from that point of view, the Americans are looking at the Middle East going, oh, Jesus, do we need to spend all this money monitoring the oceans just so everybody else can trade, right? So we're helping China because we're securing the trade routes for everybody to deliver their stuff to China. And now the Chinese are going, yeah, well, we're going to do you in. And the Americans look at that and go, okay, well, if that's the way you want to play it, well, we'll do the same game, right? So you've got this perverse idea where the Americans preach free trade. The Chinese are going, the Americans are terrible protectionists, and the Americans are looking at the Chinese going, guys, there's nothing moves in your market without the behest of the Communist Party, right? So it's what's happened is the Americans reached a point where they went, you know what, we're sick of this shit, and they're doing what everybody else is doing, which is beggar thy neighbour policies. So now the ones who have been benefiting from America for the last 30 or 40 years or even longer are now going, oh, well, that's not fair. And it's like, well, you guys have, you've been taking the mickey for 40 years and now you want to have a shot at us. Okay, well, we're out of the game.
Turn the taps off.
Yeah. So that's why oil is critical particularly for Europe, Tom, because Europe doesn't have an internal supply.
It's relied on Russia for so long.
Yeah, exactly. Right. And that's where they're in a rock and a hard place, right?
Well, no one's talking about Russia anymore. It's all about Iran and
absolutely.
Yeah.
So that is still
conflict
happening.
of the month. Yeah. Look, I think we kind of capped off the big issue with the fact that given the threat of war and the need to be more self-sufficient, so the deglobalization piece.
Yep.
In general, we can expect further investment in things like infrastructure, mining, manufacturing, agriculture.
Yeah.
Stuff that secures your base, right?
Yeah.
We need to be able to feed our own people, right? We need to invest in agriculture. We need to move tanks around the state, right? We need roads.
We need to protect people. We need bombs.
Exactly.
All that stuff becomes a little bit more important than software companies.
Yeah.
Well, 100%.
You'll take the edge off. All right, we'll get into Monday. We talked about this last week slightly, but emerging markets are obviously looking a little bit cheaper at the moment.
Beautiful.
Relative to history. And I think this is not a financial advice, but a good place to look for some investments in the future. But also, which is more important, we need to have a look at the asset allocation you put into it. And you made a note here, also important to correctly identify the sovereign risk element to emerging markets.
Yeah.
Learned that one the hard way.
Yeah.
With Lukoil.
Hey, mate, look at me. Yeah.
Hey, but when I'm allowed to trade them again, mate, those
We'll be in
returns
for
are
it.
Yeah.
next level.
They'll be earning about 3 cents per share. The reason why is because, again, the last 30 years you can invest in emerging markets, there's a bit of volatility, but they're generally all working in the same direction, trying to get rich. These days, now the game has changed. So you've got to be a little bit more circumspect about just throwing your money in, for example, Poland, right? So the CAPE ratio on Poland is about 10. It's been cheap for a long time, but it's the next in line after Ukraine, right? And they know that. That's why they're so vociferously against Putin, right? Because they know Putin's coming for Poland. So they're the things you got to think about that you didn't have to think about sort of 2014 when Putin first went to Ukraine. So you've got to be a little bit more like, okay, let's look at the sovereign risk element of it. who are they siding with? Right, Pakistan is an example, right? It's cheap. It's been cheap for ages, but it's been in turmoil for, God knows, 5 to 10 years. It's stuck below India. Pakistan is sort of doesn't get on with India, but they want Chinese money, and the Iranians are going to visit. So there's all this sort of stuff before where no one paid any attention to it because you didn't need to, right? We're all selling each other stuff, and everyone's getting rich. So stand aside. We're all having fun.
Well, the risk is you invest in it, the taps turn off because of an outbreak in war, like what happened in Russia, and then you can't access your funds, or it just goes to zero.
Yeah, absolutely.
But
happy days.
For the grand scheme of things, emerging markets are cheap.
Other than that, pile in, folks.
There's still plenty of opportunity.
But there's
also some sneaky little mines in there.
Yeah, there is, but you just got to be a little bit, as I say, you just can't go, oh, cheap beauty, I'll pile in. Yeah. It's like, yeah, not anymore. You know.
Don't bet the house, Jacob.
I'll try.
It's not a specky miner, mate.
Yeah, not a specky miner.
Need some ruby mines. Oh, Wednesday, what we got? Rising margin debt. There's another fun one. We're full of the fun stuff today.
It's a good valuation indicator.
Well, when we spoke about this before, like this is the thing you said that's most likely going to keep pushing things higher. Even if they shouldn't, it's probably going to be the thing.
Yeah. Well, bull markets go on for longer than you can expect, right? And the reason why is because they keep going in and borrowing and pushing prices up. It's the same thing with property, right? There's some fundamentals to it, supply and demand. Yep, absolutely no argument. But does that mean you should be paying $1.9 million for a Sydney property?
Well, you can only loan money for so long, and the bank goes, knock, 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 I need some money back now. Well,
and also, too, you get to the point where you go, well, I can't borrow anymore because the extra $500 a week I have in income, I was paying $250 at 2%. Well, now I'm paying $470 at 6%, and now I've only got $30, every week to exist on. And if the bank says, well, look, Jacob, I want you to buy another property, and you go, mate, I can't pay you back. Yeah. That's when the loans start falling off, and that's when the prices fall off. And it's the same with margin debt. As you say, when they, what do you say, Tom? The market's fallen about 5 or 6%.
Yeah, this month.
Right? So you've got to look at that and say there'll be some people out there who are borrowed on margin.
They're liquid.
That a bank might say, listen, Jacob, we'd like you to give us some money. So Jacob says, the only way I can do that is take a loss on the shares. And then that means, Tom gets triggered and Steve gets triggered. And so you get the downward spiral.
Oh, I've just got this feeling that it's going to be messy when the market really turns. And no? You've got the opinion it's going to be slow and grindy.
Yes.
Yeah.
With lots of these kind of things.
Yes. Yeah. They're going to be, that's
it'll
why.
It'll go down 6, it'll go up 7, it'll go down.
Yep. And even in year terms, the big issue will be inflation, right? Because if you look from 1964 to 1982, which is a period I'm sort of angling or getting people to understand because we're sort of close to there, what you're looking at is companies made good earnings per share, right? The economy did quite all right, a bit messy in the 70s, but the big thing was inflation. So you made 8% nominal returns, but you made 1% real. And the reason was because inflation was running at 7%. And so from 64, when the Cape was at about 25, it went to about 7 in 1982. That's what I think we've got going again. We've got 10, 15 years of a secular bear market where it's a slow grind lower. But as I said, perversely, you'll have a job, you'll have a good income, and things will generally seem all right? And that's why I'm saying when you've got a steady income and it's rising, and the kids are at school and everything's running along fairly normal, you tend to think less about how am I going to make my next million? Right? The financial independence, retire early. We never had that in my day. Because we didn't need to. We got a job and there was, interest rates were 18%. Didn't matter. We had income to cover it. We had steady jobs, stuff like that. So that's where I think we're heading back to, right? Higher interest rates, higher inflation, lower returns if you invest in places like the US where the Cape's at 35.
Yeah. So
Right.
we've got to wait till we're 45 to pile in.
No, well, not necessarily, right? Like,
It's just where you buy.
Well,
right?
hopefully, price starts to trend and the whole price and value start to line up a bit better. That's what we would like to see, because that means, to your point, Jacob, we can invest in. We've got way more options, right? You've
Absolutely.
got way more options in what you can invest in.
Jesus, you guys can move your money to bloody Peru in a blink.
Mate,
Bitcoin.
I might.
That's a global currency.
Go
But
50-50.
in my day, you had to go to the bank and ask them for $5 in cash, right? You could, you had to go to the bank and get your money out. We didn't have ATMs and all that stuff. So you guys have got a lot more opportunity. You can invest in Brazil on a Cape of 10. You can invest in Poland on a Cape of 8. All of that stuff. And that's what I'm saying. I don't want people to be doom and gloom about, oh, my God, Steve's saying it's going to be terrible.
I can't invest for 20 years. That's nonsense.
Yeah. All I'm
5%
saying
cash.
is you're going to have to be a little bit more circumspect about where and when you invest, rather than just saying, hey, we're in a bull market, hey, cash,
can
just
buy
put your
anything.
money. Yeah, right? Okay, that's the point.
If you do that successfully until the Cape comes down, you'd be absolutely laughing.
Yeah.
Well, yeah. That's why we're saying emerging markets, because the Cape ratio there is cheap. Now, it doesn't mean you're going to make a bloody mozza in 10 years, but it means the probability is a lot higher because you're simply buying assets cheaper than you can get them in the United States. That's the thing, right? The US and price always returns to value.
I mean, we have seen some pretty outrageous numbers coming from some of those emerging markets, like Turkey. I think it was one of the first ones you showed me.
Yep.
Where you were showing me, the bad years it'll drop 50%, the good years it'll be up 90%.
Yep. It's a hell of a ride.
It's fun when you get it right. Shit's scary.
It's the argument against buy and hold, isn't it?
Yeah.
If you've made 90% in 12 months, what? Don't be greedy. Don't push your luck.
Take some money.
Do you really think you're going to continue on to make another 90%? It's just, and that's what I'm saying about real estate.
Right now, I'll say no, but in the moment, yes.
But that's what I mean. That's why you need a system.
Yeah.
Right? That's non-emotional. I've made money. That's the plan. Right? Get out. Now, could you have sold Nvidia too early? Absolutely. But that's not the point. The point is you got to stick to that system because that's the way it makes money over time. Right? And that's why I'm saying to people in real estate, you've really got to look at it and say, if it's doubled or tripled, if it's doubled in 4 or 5 years, you've got to look at that and say, do I seriously think it's going to continue at that rate? And I can tell you, it won't. And it won't because the debt has got to be paid from the income. So if the price of a property goes from 1 to 2 million and you've now got to borrow 1.8 million instead of 900,000, the point is, if your income hasn't doubled, you're not going to be able to afford that property, right? And that's why what we're seeing at the moment is the wealthy 10% are buying a lot of the investment properties, right? Because they're the only ones who can afford it.
Yeah, they'll buy 50 of them if they have to.
Well, that's what's going on, you see. You're getting more and more people buying more and more, particularly people of my vintage, right? Because we're the boomers with the money. And so we're either saying, well, we own our property, we're going to use that as a guarantor for, my son Tom to get a property, or we're going to buy a property and we're going to put Tom in it, right? All of that sort of stuff is going on. But my point being, that's because they're the people who have got liquidity that can afford to pay. But even it reaches a point where they say, well, sorry, Jacob, I bought Tom a property and I can't afford one for you, right? So there's all that sort of stuff going on. But my point being, eventually it stops, right? And it's really hard because you're looking at it going, man, our property's gone up 80% in 5 years. This is great. But it's really hard to go, yeah, but it's a good time to sell. And you go, oh, no, I think there's more to it because that's what people are saying. And it's like, well, there could be. But a lot of the time what you find in markets is by the time you decide to get out, it's too late. Like it's too late for someone. Remember, assets are owned by people, and somebody who buys Bitcoin at 65 or something like that at 35 is down a lot, right? Well, there's somebody who owns that asset at
At the
that
top.
bought it at 65.
Yeah.
Right? They're the ones who create the trigger when they go, you know what?
There's always a buyer, there's always a seller.
Well, yeah. You got to look at both sides. And if Bitcoin gets to 65, well, that means someone's buying it at 65. And if it falls to 35, then that person who bought it at 65 is not going to be very happy.
Exactly.
Right? And it's the same with property, and it's the same with stocks.
Well, that for me, on the Bitcoin and the stocks side of things, it's always good to have a trend indicator. Like for me, like I'll look at it and go, okay, what's the moving averages telling me? What's the MACD telling me? Especially in a really volatile market like cryptocurrency, where you can look at it.
You got some volatility there,
well,
brother.
That's what I mean. If you understand, if you got rules and you go, okay, I'm going to trade and invest by these rules, regardless of how volatile it is, and you know that your edge works, and you can win 60% of the time, for example, then that's okay. Like,
you're getting it, brother. That's all it's about.
It doesn't matter if you're investing in Bitcoin or fancy art.
Yes,
it's the same thing. So that when the stock market turns, like the S&P's obviously dropped 6% or whatever it has over the last few days, and you go, okay, well, these indicators are now telling me like the MACD might have crossed down or the price might have crossed below whatever moving average, and yes, it could still go up eventually, but I'm going to take a back seat at the moment or change my asset allocation to be 20% in the market, 80% out the market. Then that's where your edge comes through.
Exactly.
And then when the indicators say, well, now you need to be in again, you just unemotionally put your money back in the market.
Yep. As you say, Jacob, I always encourage people to think more like card player, right? Which is you've been dealt an ace, bet more money because you've got a chance of getting more money, right? So it's simply saying, look, a cape of 10, like you said last week, well, could it get cheaper, Steve? Absolutely. Yeah. But it's a really good probability of a win when it's on 10, right? Now, as we also said, well, yeah, you could get a rusher. Well, absolutely, right? But the point being, but 8 out of 10 times it's fantastic return. Okay, well, that means 2 out of 10 times you're going to lose your money. Okay, well, that means I shouldn't bet the house every single time, right? But that's your point. If you come back 10 years later and go, the cape's gone from 10 to 30, well, let's use the US. In 2009, it's like 13 or something, right? Yeah. Screaming buy. So now it's at 33 or I think it's about 35. So they are two completely different situations. Yet people are saying, oh, yeah, I should have 90% of my money in the US at all times. Well, that's just batshit crazy.
Yeah, it's nonsense.
Right? It's just crazy. And that's why I say to people, you've got to understand those market cycles, and you always sort of live with a bit of regret because it's like, oh, I sold too early, or, I didn't buy enough, or there's always that stuff.
But look at what you made in the middle. That's what people forget about.
Yeah. Yeah, listen, dude, you made 90%. You've done all right, right? But, that's the way it sort of works.
It's fascinating. I find it fascinating anyway. Thursdays in the week that was, Apple have finally started to have a bit of a knock on their head. They've sold less than their projected 10% of sales.
Yep.
And it's facing its worst slump since COVID. And this is all to do with, well, not all to do, but there's a lot to do with Chinese not allowing iPhones in certain workplaces. The shops that usually sell iPhones are not anymore. They're selling competitors.
Yep.
So Apple's projected sales, which drives stock market price, we know what happens when they don't hit their projections. So you have slumps in the market, right?
Yeah.
So we're starting to, another one for Steve's I Told You So.
Yeah, and we'll see more of this, right? Presumably.
Absolutely.
Yeah.
Well, now, think about this. They're losing sales, right? So their revenue is shrinking. And on the opposite side, they're spending billions in investment in India and Vietnam and other places. So you see the double whammy. Mm-hmm. Oh, guys, we're not going to make $100.
We're spending more and we're earning less.
Exactly. That's where you look at it. Now, but you think about that, Tom. As an Apple shareholder, you're going, well, this is not very bloody good. As an Indian manufacturing worker, you're going, man, this is fantastic, right? Because you're making iPhones.
Yeah.
Did you like that accent?
I thought you were going to do one. But
that was a Mumbai accent, by the way. So
couldn't believe it.
It's a little bit different from the regional accents.
I figured you'd try and do one, but
that's my point. My point being, That's where you say things are really good, but I'm not making much money as a shareholder.
Yeah.
Yeah.
Right? Because the company's got less revenue, higher cost, but you've got a really good job.
Yeah.
Right? That's where I say we're going to. Which, as an investor, you're going to go, this is really weird, like Apple's got really decent sales and they're building all these factories.
Yeah, everyone's using an iPhone. Like, what's the matter?
Exactly. But it's about the profit margins, right? And the last 30 years, companies have had really big profit margins, which they've been able to give back to shareholders. Right?
Yeah,
and
it's almost an expectation now as a shareholder to look at the growth rather than the dividend.
That's exactly right. Right, because it's like, they've been growing crazy. Well, let's just look at the projected growth levels.
Yeah.
Right now, everyone's starting to look at Tesla going, we might have to revisit Mr. Musk's company because, see, Tesla's now suffering in China. Why? Because the Chinese are saying, don't buy those American-made cars, you buy our cars.
Yeah, we'll subsidise the BYDs.
It's exactly right.
But Elon's openly said, like, you guys shouldn't be buying these stocks at this price.
Yeah. Well, it's not up to him. Everyone's going, this is amazing. We're going to buy this.
He's more interested in Twitter now.
Yeah.
Space now.
Oh, yeah.
The new frontier.
Anyway, what else have we got?
Well, we've got Fridays. You want to cover that?
Yeah. Well, on Friday, increasing focus on China's overproduction and the damage that it causes to the other countries' manufacturing capacity. And we've just put this won't end well for China.
It's just a huge point. Right, because the Chinese have a model which is basically, I'm going to shortcut it here. Basically, China says there's three sources of growth, like every economy. There's domestic economy, right? I'm going to give Chinese people lots of money and they're going to buy lots of stuff.
Yeah.
Right, cool. Okay. The second one is I'll give money to Chinese companies and they're going to build lots of stuff and that will be a source of growth, right? Investment-led growth. Third is we're going to build lots of stuff, we're going to sell lots of shit to people overseas, and that's export-led growth. Yeah. Let's do that one, right? Because the Chinese government says we don't want to give Chinese people lots of money because then they'll get fat and lazy like all those Westerners. Oh, well, we don't want that. Right, well, let's keep them on this sort of marginal income and we'll export our heads off, right? That's why the Americans have said we've had enough of this stuff because the Chinese are now saying we're struggling with domestic growth. What are the things we've got to spend on? Well, we can give people more money. Okay, we're not doing that. Okay, well, we can give companies more investment money. Okay, well, that's a good idea. And then we can get those companies to export their electric vehicles and flood Europe and America and crush all those local BMW and right Holden and Ford and all that sort of stuff, right? The Chinese go, yeah, that's a really good strategy. But Europe and America are now saying, guys, you can't continue to do that.
Well, they're putting tariffs on it, right? They're saying you can do that, but you got to pay us 50% more than what you used to.
Yeah, but you see what's happening is the Chinese are saying, well, you guys are being unfair, right? You talked about free trade. Well, not anymore. Plus, and this is where...
You're ruining the game for us.
Well... Yeah. This is what happened with Japan, right? The Americans had to go to Japan and say to them, guys, you can't keep subsidising like that because it's unfair, right? But turning around the Titanic in China, where you've got a certain cohort, their wealthy elite, they don't want to change the system in China, right? The same as the wealthy elites in America and Australia and England and Canada and, Bhutan, they don't want to change the system because it suits their purpose.
Yeah, it's working just fine.
Absolutely,
I'm fat and happy. Let's not change it.
But that's the point, right? Because that's where China is saying, no, we're doubling down on this stuff. And that's where I think they're going to have a real problem, right? Because they've got manufacturing capacity for 35 million cars a year. It's like, guys, you're not going to be exporting all those cars. Let me give you the tip, right? But they're playing politics. They're, as you, I think, said last week, Jacob, they're using propaganda to target people to say, well, your governments are being unfair to you because
we're doing okay here, but you're not playing the game over there.
Well, yeah. Plus, also they're saying, well, don't you guys want to use TikTok? Your government's going to cut TikTok off, and you go, oh, that's outrageous. I love TikTok, right? Whereas it's a tool for the Chinese government. So that's what you got going on, right? Russia's doing the same sort of thing, right? This is why you get these propaganda wars. because there's a lot at stake, right? Because you've got a bunch of screaming teenagers going, well, we want TikTok, TikTok, TikTok. They've got no idea about geopolitics, right? They've got no idea what China. They don't care what China does with their data, right? But that's where national governments are saying, they're going to manipulate the data and your behaviour and use it against us, right? And that's why the Americans and everybody is now turning against them, because it's got to the point where, we've talked to them, and we're, well, not they know too much, but the point being that they're now hostile, right? The Americans see the Chinese as being hostile. So China sees America as being hostile. Well, here we are, right? And this is a result of when globalisation gets pushed too far, right? And that's what you see coming out. And so that article is really important, because what I'm trying to get across to people is get used to this, because you are going to see a hell of a lot more of it. And that's the reason why Europe are trying to secure critical metals. Australia's got a critical metal strategy with subsidies. We got a build in Australia, made in Australia campaign going, right? All of this is in a response to the change in the global dynamics.
Well, we should probably wrap it up there. One thing I think worth mentioning before we go, I know we briefly touched on it last week, but probably didn't emphasise it enough. The week that was something that used to only be available to members. Anyone can now subscribe. You'll get a PDF. You'll get a video that'll go for a few minutes kind of explaining what's happened. The point of this is to kind of filter the signals from the noise, cut out the rubbish, and that'll be delivered straight to your inbox. So to get on board with that, just jump on our website. Should be really easy to register, and you'll start to receive these updates.
Sure.
Arigato.
Thanks, everyone.
Perfect. All right.
Cheers,
Thank
folks.
you. Cheers.
Cheers, mate.
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And as always, remember, we don't provide financial advice.